All right, let's get right into it. We've all heard about this thing called gamma, right? This kind of hidden force that's supposed to move markets. But that's all theory. Today, we're going to get practical. We're actually going to build a real, usable trading strategy from the ground up using this exact concept. So, you know gamma moves markets, but how do you actually trade with it? I mean, really, what do you do? If you've ever felt that frustrating gap between knowing a concept and actually being able to use it, well, you're in the right place. We are going to bridge that gap right now. Okay, first things first. Before we can build a strategy, we've got to be super clear on the main ingredient here, gamma exposure, or GX for short. Just think of GX as the hidden engine under the market's hood, the thing that's really driving all the short-term moves. So what is GX, really? It boils down to answering one super important question. If the price moves, how much are the big market makers going to have to buy or sell to hedge their books? And trust me, knowing the answer to that question, that gives you an absolutely massive edge in figuring out what's likely to happen next. Okay, whoa, don't let the formula scare you. You're not going to have to do any math, I promise. The only reason I'm showing you this is to make one simple point. GEX isn't some kind of vague gut feeling. It's a real, measurable force in the market, something we can actually track and use. So we've got this number, right? This GX value. But what does it actually mean for us as traders? Well, this is where it gets good. Because whether that number is positive or negative, it basically tells you the market's hidden mood. Is it going to be a calm day or a crazy one? GX holds the answer. It really boils down to two different worlds. In a positive GX world, dealers are long gamma. They act like a shock absorber for the market. They sell when the price goes up, and they buy when it goes down. It keeps things nice and stable, contained. But when GX flips negative, everything changes. Now they're short gamma, and they're forced to do the exact opposite. They have to sell when the price is already dropping and buy when it's already rallying. You can see how that's just pure jet fuel for big, volatile moves. Okay, so knowing the market's mood is one thing, but how do you trade it? You need a map, and that's exactly what this data provides. There are 3 and only 3 critical price levels that you need to draw on your chart every single day to create your trading map. Number 1, the big one, is the gamma flip. This is your on-off switch for volatility. Price above this level, things are calm, dealers are keeping a lid on things. Price drops below it, bam, volatility gets unleashed. Then you have your 2 boundaries, the call wall, which acts like a massive ceiling of resistance, and the put wall, which is like a giant floor of support. These 3 lines, this is your whole battlefield for the day. So you're probably thinking, great, but where do I get this stuff? It's actually way easier to find than you'd think. There are some fantastic services out there. Spot Gamma, Options Depth, Trading Flow, they all provide these levels. And if you're into crypto, Deribit's got you covered with their data dashboards. All right, let's recap. We've got the concepts down, we know the key levels to watch, we know where to find them. Now it's time for the main event. Let's put this all together into a practical, powerful strategy that combines gamma with volume profile. This is where you get a real edge. Okay, so here are the 3 main plays. Play number 1, the long gamma range. This is your setup when the price is safely above the gamma flip and trading in a value area, a place with tons of volume. The game here is simple. Fade the edges. Buy the dips, sell the rips. Play number 2, the short gamma breakout. This is when things get exciting. Price drops below the gamma flip and enters a low volume area. Think of it like an air pocket. Here, you don't fight it, you follow it. You trade for a breakout. And finally, play number 3 is strike pinning. When GX is super high and the price gets sucked towards a big option strike price, you can often trade mean reversion, fading any moves that get too far away from that strike. Let's walk through a real-world example to see how powerful this is. So picture this. The market's already looking a bit weak, and then it happens. The price breaks down below the gamma flip, and at the same time, it slices through a key volume support level. What do you think happens next? It's a perfect storm, a total domino effect. As soon as we cross that gamma flip, dealers are forced to start selling to hedge their positions. But here's the kicker. Because we're also in a low volume air pocket, there's nobody there to buy what they're selling. And the result? A waterfall, a fast, nasty move straight down. This right here is how you find and trade those explosive, high-probability moves. Look, knowing these setups is awesome, but the real money is made through consistency, and consistency comes from having a solid process. So let's shift gears from just the what to the how. Let's build a professional-grade framework that you can use day in and day out to make sure you're always ready. Here it is, your simple, 5-step, Pre-market routine. Before that opening bell even rings, you do this. Step 1. What's the gamma regime? Positive or negative? Step 2. Mark your 3 key levels on your chart: gamma flip, call wall, put wall. Step 3. Identify those walls. Step 4. Where's the price right now compared to those levels? And step 5, the most important part, form your bias. What kind of day are you expecting? A choppy range day or a clean trend day? This whole thing literally takes 5 minutes, and it will completely change how you approach the trading day. So if you remember nothing else, remember this. Before you even think about placing a trade, you run this 3-point checklist. Question 1, where is the gamma flip? Question 2, are we in a positive or negative gamma environment? And question 3, where are the high and low volume areas on my chart? If you can answer those 3 questions, you'll stop guessing and you'll start trading with real professional structure. And really, that's what this is all about. This whole approach is about getting in sync with the big money, the institutional flow. You're using gamma to understand why the market is moving, and volume to understand where it's likely to move. It lets you completely ignore all the random, distracting noise. It all comes down to this one simple, powerful idea: trade the flow, not the noise.